Thank you all very much for joining us this morning. My name is Steve McMenamin. I'm from the Indian Harbor Group here in town. I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. I'd like to very much thank, it gives me great pleasure to welcome Peter Lawrence and Diana Fraser back as the underwriters for today's event. And Diana, this may be a little surprise to you. Would you like to say anything to the members this morning?
This is a real surprise. Happy holidays. And the venture capital industry is not over.
It is not over, and that's why we're here. We'd also like to thank the Bruce Museum for giving us a comfortable place to meet this morning and gather. Our topic this morning, Issues and Outlook in Private Equity, is our sixth installment to the discussion we first began in December of 1996. In that session, Ed Mathias and Diana Fraser pointed out that this asset class had the best risk-adjusted returns of all asset classes. 7 years later, we're back to examine what happened since and hopefully to learn what may happen going forward. We're also back to follow up on last year's excellent session where Ed Glassmeyer's eye-opening contrast between venture capitalists and buyout artists talked about some issues that were a little sensitive at the time. But before we begin today, I'd like to ask you, and you're getting much better about this, to please fill out the backside of the invitation card you received at the door this morning so that we can do a better job. Today our panelists are some of the best athletes in their event, and at this point I'd like to introduce them. Sitting to Peter's left is, joining us again, is Ed Mathias. Ed is an old friend of the Roundtable. He's a managing director and one of the founders of the Carlyle Group, a global private equity firm based in Washington. At Carlyle, he serves as a member of the investment committees for Carlyle Venture Partners, Carlyle European Venture Partners, Carlyle Asia Venture Partners. Prior to joining Carlyle in January of 1994, Mr. Mathias was a member of the management committee and the board of directors of T. Rowe Price in Baltimore. Ed currently serves on the board of trustees of the University of Pennsylvania. He is a member of the Penn's Board of Overseers and its investment board that oversees the university's endowment. He is a member of the Council on Foreign Relations and the Trustees Council at the National Gallery of Art. Ed Mathias holds an MBA from the Harvard Business School, and what's not on his bio is that he's mentored a legion of successful portfolio managers and venture capitalists in our industry. Sitting to Ed's left, Kevin Magid is a managing director of the Buyouts Group and is responsible for the firm's Mezzanine debt business, which is based in New York. Buyouts is a fund management firm whose founders hailed from Bain Capital. Buyouts focuses on private equity, venture capital, and mezzanine debt funds. Buyouts Mezzanine is actively engaged in the middle market of mezzanine financings, which provides financing for leveraged buyouts, managed buyouts, corporate acquisitions, and recapitalizations. The fund's target investment size ranges from $15 million to $40 million. Before Buyouts, Mr. Magid was a managing director in the leveraged finance merchant banking group at CIBC World Markets. Before CIBC, he worked at Wasserstein Perella, Kidder Peabody, and the old Drexel Burnham. Mr. Magid earned his MBA from the Wharton School at the University of Pennsylvania and is a Phi Beta Kappa graduate of Tufts University. Sitting to Kevin's left, Michael Bingle is a managing director of Silver Lake Partners, joining that firm in 2000, where he is based in New York. Silver Lake is a leading-edge private equity firm focused on large-scale investing in technology, where they often partner with management teams by adding value beyond capital that they commit. Mr. Bingle has significant experience in private equity investing and large-scale mergers and acquisitions. Before joining Silver Lake, Mr. Bingle was a principal at Apollo Advisors, where he structured and harvested a wide variety of private equity investments. Before Apollo, Mike worked as an investment banker in the leveraged finance group of Goldman Sachs. And Mr. Bingle holds a BSc in biomedical engineering from Duke University, where he completed a 2-year fellowship for the National Science Foundation, developing new ultrasound technology for medical imaging. Mike lives across the creek in Riverside, Connecticut. And against his strenuous protests, Peter Lawrence is the moderator of the Greenwich Roundtable today.
Correct.
He didn't want to do it. Peter is the co-founder and managing partner of Flag Venture Partners, the first private equity fund of funds dedicated to families. He is a member of our programming committee and a founding member of the Roundtable. Under his watchful eye, Peter keeps reminding us that alternative investing is not the exclusive domain of hedge funds. And we're very proud of Peter and his partner, Diana Frazier, and the firm they built. Flag is the only member of the Roundtable to have a Harvard case study written about them. So without any more chatter from me, please welcome Peter as he sets the table.
Thank you very much, Steve, for the introduction. I am happy to be here, not necessarily happy to be sitting in Hunt's shoes. Hunt is awfully good at this. Few words that strike fear in the hearts of investors: the bubble, overhang, efficient markets, recession and bankruptcy, alignment of interests. These things scare us to death. A year ago, we heard from really three eminent venture capitalists who described really an industry that was in the throes of really significant and painful rationalization. They did leave us with a glimmer of hope that, in fact, the venture industry might someday return to its former glory. Today, we're going to focus on the non-venture, the very large non-venture part of the private equity industry. Returns, despite what might have been said in the 96 meeting, returns for late 90s buyout funds have been nothing less than dismal. Raising the question, has the buyout industry reached a structural impasse where risk-adjusted returns simply won't materialize going forward? So are LPs, can LPs be rewarded for their long-suffering illiquidity? That's the underlying theme as we get into some specific elements of the buyout industry today. And to kick that off, we thought we'd start with Ed, who's going to give us a good broad overview of the market, and none better than one of the largest firms with the longest and most diverse tentacles, Carlyle. So.
Good, thank you very much. I was a little nervous when I first came in because we were standing in the room ourselves, and I thought we'd have no attendees. I didn't understand how it worked, and that's kind of been typical of what's been going on in private equity, and particularly venture capital. I was last here, I think, 7 years ago, and let me just say, I hope that we're going into a couple years like followed us then, and I'm going to handle the first 3 or 4 years of the boom and let the others handle the downturn.
Oh, way to go.
Just by way of my background, let me make two things. One, I'm quite unusual in the private equity business because I come from a public market, having spent 25 years at T. Rowe Price, so I tend to look more broadly than some people. And Carlyle, for good or ill, is a very unusual firm in that we have a range of products. We have a diverse group of alternative products, and we also operate on a global basis. So we have a pretty good window. We also have 13 independent fundraisers, or marketers as they like to be called. So we have a good sense of what's going on. I'm going to try and relate some of the things that we see. In a short period, you could cover a lot of material. I'm going to start off with 4 issues that seem to me very topical and relate to private equity, LBOs, and to some extent alternative assets. But these are the questions that, from my perspective, people are asking as they look at the asset class and try and look ahead. The first is, how can you get satisfactory rate of return for an aggregate portfolio in a period when people think that the stock market and the bond market are going to provide charitably lackluster returns? The conclusion that people come up with is that you need something incremental, something at the margin, some kind of inefficient asset class where you can add some value and get incremental return to get yourself to what I think is the consensus, certainly among institutional investors. Can you get 7 to 9% over the next 5 years? People may be wrong, but they're basically projecting that the stock market and the bond market itself will not provide that, thus the interest in alternative assets. And it was mentioned at the outset, hedge funds swamp everything else where the interest lies, but I think venture capital and LBO funds fall into sort of the same category. Second point is people are very concerned about diversification as they look back and think about fighting the last war. They're looking for non-correlated assets in what they perceive, and it may not be correct, to be a much more hostile environment. And again, alternative assets of various types provide that. Thirdly, which is something people didn't think about as much a few years ago, is cash flow, both income and distributions. Today, if you're in the LBO business and you are not returning capital, you are not going to raise another fund. I think the word that people use is exits. And the idea of trying to stretch the rate of return or try and hold an asset longer versus returning capital to the limiteds is, an area that's generating a lot of controversy and a lot of pressure from the limiteds. The fourth area is one I'm sure you all have to deal with, is how do you cope with a range of products and strategies that's out there today? There's 900 venture firms, there's 7,000 hedge funds, there's probably 500 LBO firms. How do you deal in a relatively unstructured market where there's not a lot of information, they're non-regulated, et cetera? How do you deal with that? How do you process information? How do you identify firms? And again, this applies to LBO firms, but it's also broader in terms of alternative assets. So how do you execute the strategy? Let me lay out now some issues that relate to this. I'll focus on LBOs, but it's really, a lot of these apply in a much broader context. Steve alluded to it, but we've really been through a boom bust, and now we're kind of coming out of the environment. Private equity was not immune to this. I think what you would see when we finally get the numbers is that the LBO funds were much less volatile than what was the case with venture. I mean, my guess, and Peter could comment, is the 99-2000 type venture funds, on average, are going to return less than 50% of their capital.
Average. Correct.
Average. I mean, there's some dispersion. We've never seen anything like that in venture. The last bad period we had was 83, 84, and they basically returned the capital. So this has been a very unusual period. NASDAQ was down 79% peak to trough, S&P 45%. Interestingly, the LBO funds were not down anywhere near that. And not that they were up, but basically they maintained some value during this period. And I think in all the areas of alternative assets, we're now kind of coming out the other end. The economy's up, the market's up. In the LBO business, probably the most important factor has been the hospitality of the debt markets. That in essence, the debt markets have helped a lot of, I don't want to say second-rate companies, but let's say highly leveraged companies work their way out of problems. Debt has been very cheap. You've seen it in the junk bond market. You've seen it in distressed debt. I'm sure you'll comment about it. But that has been a huge factor for the LBO business. Importantly, though, there have not been a huge amount of exits. And we're starting to see that now. The returns, for the most part, have come from recapitalizing the company. But now we're starting to see more M&A activity. We're starting to see, modest IPO, initial public offerings. But also, we're starting to see what I would call a lot of trading among financial partners. I mean, XYZ firm is buying from ABC, et cetera. And that has gotten the market. The one thing we know, and I'm sure none of you are susceptible to this, but the inviolate rule for most investors is that money follows performance. So people were very discouraged about private equity, particularly venture capital, but some LBOs. But as performance picks up, you're starting to see interest pick up again. Funding, the first thing I would say is that the private equity market in general is infinitesimal in the scope of the financial markets. I mean, LBO firms in the aggregate have less capital than Microsoft or GE's market cap, just for perspective. And the overhang that people talk about in venture capital is not equivalent to Microsoft's cash on the balance sheet. So these are small industries. Having said that, they're not immune to the cycles. In 2000, there was over $100 million raised for LBOs. This year, there's going to be probably, depending on how you count, $15 billion. And that does not include Mezzanine, which I'll let talk about. Venture capital, which peaked at $120 billion, is going to be less than $10 billion. And again, these are soft numbers, but they're not off by much. First time that we've ever seen it is that there was more money raised this year for LBO funds in Europe than there was for funds in the U.S. A marked change. And again, we're seeing the interest in the LBO funds, partially from what's available in the market, seems to be what I would call the middle market funds, the smaller funds. Activity has really picked up at all levels. The real change at the margin has been the emergence of what I would call mega LBOs. This year there were 15 LBOs done of over $500 million in equity. That is just unheard of in the business. Now, they've been syndicated, this and that, but this is just a real change. We're also seeing a number of venture capitalists come into the lower end of the LBO market. And I would say, and maybe Peter or Diana want to comment on this in the question area, I think the LBO funds understand the business, not necessarily investments, but the business better than the venture funds. And they basically understand the impact of time and fees, they're basically financial engineers, on your returns, and the need to invest the money more rapidly if you're going to have a decent IRR. And they have picked up the pace dramatically. Banks have been accommodative. There are a lot of companies for sale, financial sellers looking for exits. Prices are up somewhat, but I don't think in any way they reflect extreme conditions where you would say this is an anomaly and you should stay out of this market. I'll come back to it, but higher prices are going to translate to lower returns, and there's some other factors there. Let me kind of just highlight some issues and what I think are some opportunities. One thing I've always got a kick out of, when you go in and talk to a major pension plan or an endowment or foundation, you're in there saying, well, we're going to provide 35 to 40% rate of return, and they're penciling in 15. And I think you can probably think for a good private equity firm from this time that a 15 to 18% return would be more than satisfactory. I mean, there's very little reason to expect that in a institutionalized or semi-institutionalized market with low inflation, low interest rates, and expected returns from the stock market of 7, 8, 9, whatever you think, that you're going to get 40 or 50% from sort of financial assets. What I have seen is over a long period of time, private equity tends to return 1.5 to 2.5 times your committed capital. And the IRR is really a function of how long it takes to get it done. And I don't see any reason why that should really change. The return of capital, if you look at, we now have some interesting data from the state of California, state of Texas. The return of capital or the cash on cash over long periods of time is not all that encouraging. And I think there's going to be a lot more attention on that in the future. Second issue that I'd raise is this a scalable business? We know that venture is not a scalable business, but there are 80 funds over $1 billion in LBO. As you get bigger, the numbers are inviolate. You either have to do more deals or bigger deals, and either one tends to change your strategy. And I think that's something you really have to watch. One thing that we've seen a lot is that investors, particularly in LBOs, like co-investment. I mean, they like the idea of putting the money to work in a specific deal. They like getting the money to work right away, et cetera. And I think more and more firms are paying attention to that. As someone who got beaten up for years, and Peter DiPuzzo kind of knows about this, the fees to brokers and investment managers, you negotiated like crazy and then capitulated. The private equity business has been impervious to pressures like that, and that is changing quite dramatically. It's changing in terms of fees and terms. If you want to be a big fund today, you have to deal with big investors, and they have some leverage. Transparency is an issue. It's kind of interesting why people are fighting the disclosure of IRRs, which are basically meaningless. And I think the reason they're fighting it is that that's just step one. Next thing's going to be terms, what's going on in the partnerships, how are you distributing profits, et cetera. So you got to kind of make a battle line and do that. Next thing I'd mention is global. It's much more complicated than you think. I mean, we deal globally. We have people on the ground, but when you do a deal in Europe, you're dealing with 11 countries, different currencies to some extent, regulations, et cetera. And that's an issue. Two anomalies that strike me today that relate to what we're doing. One is that small public companies are cheaper than private. And you're starting to see a lot of middle market LBO firms. You're seeing public market investors. Peter just mentioned to me a PIPE they did. Pipes seem to me a very, very interesting area of opportunity, and there are very few people that focus on that alone. The second anomaly that I alluded to it before is low-grade debt. It's just mispriced, and that will have some implications down the road. We're seeing people look at new strategies and sectors. The one that jumps out at you is power. However you want to define it, utilities. Warren Buffett's doing it. It's huge. It's going through restructuring. It could absorb huge amounts of capital, and you're starting to see a lot of the big LBO firms go to that. There's a lot of talk about taking companies private through the LBO transactions. That's a very, very difficult thing to do. You're just not seeing a lot of it. I don't think there's much of an overhang of money in the LBO business. They are putting it to work very dramatically. It's a big market. I just don't think it's a factor, whereas in venture, it clearly is. The idea of identifying the best funds, if you're in a fixed income business, the difference between first quartile and third quartile might be 20 basis points. And if you're in venture capital or LBOs, it could be 1,000 or it could be 1,500. The difference between the best firms and the run-of-the-mill firms is just dramatic. And how you get in and identify the best firms is a real issue. And finally, and this is something I think you have to monitor closely if you're going to invest, is changes within partnerships. You're getting generational changes as they bring in new people and the people who started the firms kind of wind down. And you're also getting strategic changes as people perceive opportunities in other areas. And at the end of the day, the data is probably not that important as the qualitative judgments you make about strategy and people. I remember talking to an academician. He said, well, you need 50 years of data to be statistically significant, which we don't have. So the qualitative factors in assessing a partnership are very important. Let me just finish with two issues, or three, really, that this is a reasonable time to be in LBOs. I don't think it's an extraordinary time. I think you will get returns that are superior to the public markets. It's really a very simple business. You don't overpay, you use some leverage, you pay down the debt, and you hope you get lucky. And then get some growth. Our sense at Carlyle is very strongly is that through purchasing companies and financial engineering, you are not going to get extraordinary returns. I don't know if you've watched, but we have brought on a tremendous number of operating people. Our sense is you're going to earn your extra return on the factory floor, so to speak, not on Wall Street. And that's a real change in the business. I think, secondly, Europe does look very interesting, but it's very difficult. And there's a real dispersion. You do U.S. firms that are trying to go to Europe, or you go find people in Europe. How do you do it? The case for Europe, I think, is reasonably compelling. Thirdly is returns are going to be lower. There's just no question, at least in my mind, about it. Less leverage, higher prices, more competition, whatever. And so, I think the 15 to 18% net would be a very good rate of return. And finally is that there is, and I think it's going to increase, going to be large institutional demand. And that will change the industry. And institutions seem to have, for a variety of reasons, some of which don't have to do with the opportunities, a strong preference for LBOs over venture capital now. And some of it's just what the performance has been, but some of it is, and again, Peter could talk about this, you cannot put significant amounts of money in venture capital. If you're the state of California and you want to put $100 million per fund, Kleiner Perkins is going to give you $1 million if they take you, and they may not take you. And executing strategies in venture is very difficult. So I think you'll see increasing amounts of money in the private equity area where the allocations are big, allocated to sort of LBO firms. And they'll probably, to some extent, go with some of the bigger pools of capital. And I think what happens is a lot of them are looking for the industry rate of return. It's almost an enhanced index when you start putting billions of dollars in the area. So they probably have very different objectives than you do. So I think with that I'll finish and let We'll come back for Q&A.
Just one quick follow-up on that. It gets to returns. If that's the case, and I'm looking not to point a finger at Carlyle necessarily, but you're looking at a firm with 300 investment professionals, 17 billion under management, 30 different products or whatever the number is. If you're an investor like we are, and you are trying to identify that buyout firm that is likely to outperform in a market that is, we can get into this issue of being more efficient or what have you, but in a market where we are expecting longer-term declining returns, how do you identify that right firm? Can a large firm actually be an outperformer with running that?
Well, I think the evidence, not just ourselves, but the evidence. First off, I would look at a certain structure. I personally don't believe in so much in group dynamics when you do LBOs. I think to have a really strong chief investment officer that you have confidence in, who has a team under him. And if you look at the best firms, that's what they do. David Bonderman, I think at our firm, Bill Conway. These are very gifted investors who have shown they can run large amounts of money. But I think a lot of it is just good due diligence. And do you believe in the strategy? Are they following it? I mean, we have a lot of products, but they're semi-autonomous. Some are good. Some haven't had such a good record. That's just the nature of the business. I really believe, though, in the LBO business, focusing on the chief investment officer and how that person operates and what the strategy is the absolute key element. And where in venture you have a lot of partnerships and people getting together making consensus decisions, my experience is that is not what makes for a good LBO firm. What it really takes is a very strong investment leader that's, I don't want to say dictatorial, but very, very focused and basically runs the ship.
Yes, surprisingly, we're about to move to someone who's going to tell us a bit about the Mes Debt Market, and one would think that would be a more efficient market. I think we may hear, than the equity side, we may hear a different story.
Sure.
That's good.
Thank you. Thanks for the opportunity to discuss the Mes business this morning, which is certainly a different and less global topic than Ed covered. We are, at Audax Group, we are the pipsqueak relative to Carlyle. We have about $1 billion under management. But in the Mes business, with a $440 million fund, we're probably in the top 6 or 7 in terms of fund sizes for third-party independent mezzanine funds not attached to larger investment banks or so. So we have a pretty good window into what's going on in the Mes market on a day-to-day basis. We're focused at Audax in the middle market, somewhat like Carlyle. We do have a private equity fund and a mezzanine fund. I spend all of my time on the mezzanine business. And our focus is middle market transactions, mostly done with middle market private equity firms, so a little bit smaller than Silver Lake or Carlyle. And we focus on companies that have $7.5 million to $40 million in EBITDA. So a certain kind of business that may have revenues anywhere from as small as $40 million to as large as $500 million. But again, most of these companies are private companies, and in some cases we get companies with public equity and or public debt. Mezzanine is a portion of the alternative asset spectrum that is somewhat smaller than private equity, venture, or hedge funds, but is an important part of many different investors' portfolios. And to give a range of market size, much like Ed did in the private equity business, I think the biggest year for third-party Mez fundraising might have been $4 billion. Last year in 2002, believe it or not, it was less than $1 billion. And this year, you'll probably see a number closer to $2 billion of money raised for either final closes or folks in the midst of raising another mezzanine fund. If you add to that, and it's a little bit of a misnomer, because public companies, public vehicles, as well as the banks, depending on when they're lending significantly or pushing leverage, also tend to be competitors in the Mez market. But overall, in terms of market size, there's probably not a lot more than $10 billion being put to work by third-party or other public managers in any given year, just to give you a sense of size versus the 15 to maybe $100 billion that can be raised in the private equity or venture business in any given year. For those of you less familiar with the asset class, I'll just give a short introduction to mezzanine. And someone who who I think had a pretty good idea of explaining an asset class to folks who have different levels of familiarity with it, said to me, why don't you just explain it like you would explain it to your mother? And I said, what do you mean by that? He says, just try it, and I think it'll work out. And I've done that on a few panels, and we'll do it in a short way today. Of course, when I left Wall Street and told my mother after 15 years on Wall Street that I was going out to raise a mezzanine fund, she looked at me like I was crazy. She had no idea what a fund was. She thought it was charity, to be quite honest. And then she certainly had no idea what mezzanine was. But I think the simplest way to describe it is it's the corporate equivalent of a second mortgage. If you think about going out and buying a house, we lend to an asset on basically a loan-to-value basis. And that value might be the cash flow of a company, the assets of a company, or enterprise value, or all three of those three things combined. So if I give an illustration of buying a house for $100, and those of you from Greenwich are laughing like that's your hourly mortgage bill. If I'm buying a house for $100 and I've got $10 million to put down in equity, I might have a bank that says to me they'll lend $70 against the value of that $100 house. If I've only got $10, I need another $20 to fill that gap. The folks who fill that gap might be a company that gives you a second mortgage. And what they will do is they will charge a higher interest rate than the first bank, and they'll be taking more risk than that very first bank. And the reason that they'll do that is if, probably not in Greenwich, but if the value of homes ever do drop by $10, the first person who loses their money is the equity. And the second investor that loses their money is the folks with the second mortgage. So they are taking more risk, and in many cases, banks lending to real estate don't often lose 30% of their value, but certainly if you remember the crisis in the 90s, that does happen. Corporations are inherently more volatile than real estate, but overall, in the broad spectrum of different assets, they're not overly volatile. So mezzanine is really the corporate equivalent of the second mortgage. How do we generate our return? Banks lend to companies at probably a LIBOR plus 3, 4, or 5% rate, which equates to around 4, 5, or 6% today, which is quite low. And mezzanine tends to generate a 12 to 13% cash coupon, and among other ways that we get our return, which I'll walk through. So it gives you a sense of that next level of risk that you're taking in mezzanine and how you get return for that. On a global basis, sort of from a risk-return perspective, somewhat like Ed was describing, which I agree in terms of the numbers that he hit in terms of private equity, Mez has less risk than private equity, but you will get slightly lower returns than private equity. Private equity folks who send us models or financial models are looking for a 20 to 25% base return. There will be deals that they will get a lot less than that, and there will be deals that they will get significantly more than that, and that translates into 1.5 to 2.5 times their money, depending on the range that they can make, or that 15 to 18% net return. In the mezzanine business, we target IRRs of 16 to 19%. Take the midpoint of that range, and a good mezz fund should return you 1.5 times your money, probably in a shorter time frame, and we'll talk about that some more as well, but also taking less risk. So as a mezzanine investor, you're taking a risk-adjusted view on effectively the private equity market, because we make our mezzanine loans to private equity firms to conduct and complete their buyouts. In terms of the investor class, who is investing today? And I'll help you with some examples of our investors, because mezzanine is not a well-known asset class across the broad spectrum, except for folks who have been around it for quite a while or been around private equity for quite a while. Pension funds, both public and corporate, university endowments, insurance companies, family offices, fund of funds, and individuals are all in our fund. So as an example, on the public pension side, CalPERS is an investor. On the corporate pension side, DuPont is an investor. And on the university endowment side, Mike's alma mater, Duke, is an investor. And on the insurance company side, Allianz is an investor. In fact, one of our investors is here in the room today. So it is a broad array of all of the different types of alternative asset investors that are actually in the mezzanine asset class. Enough of them have found a reason to have mezzanine in their portfolio. And why are they doing that? Generally, I think there are three main reasons. A good absolute return, 18% gross, 17% gross, that turns into 13% net, probably over the past 3 years if you've been able to find some of the better mezzanine funds in the market. Certainly others have not delivered that if you haven't found the better mezzanine funds or been in the top quartile. Stability being added to your portfolio. With private equity, venture, distressed, or high beta hedge funds, mezzanine adds some stability to the portfolio. And how does it do that? It does that through current income and generating earlier distributions, or as we've been fundraising, the D word, which has become a very big topic, as Ed has mentioned. The components of our return are, as I noted before, cash coupon of 12 to 13% on average, maybe sometimes lower, sometimes higher than that. We have both in our portfolio. A pay-in-kind coupon or a PIK coupon, which adds to the ultimate principal of the loan you are making of 1 to 2%. So combined, you're generating about a 13 to 15% return on the coupon as long as you've made a good credit decision. Warrants, and I'll pick a number, 2 or 3% in the company. That would be the corporate equivalent of lending to a house and getting equity ownership in the guest room, or getting 2 or 3% warrants in a company, and then an upfront fee of a couple of points. Overall, if you mix that all up, and that is all generally negotiable in a transaction, you tend to generate about an 18% return across those different components of return. And focusing on distributions for a minute, why people are interested in mezzanine, let's use our fund as an example. We have a $440 million fund. We have a 1.5% management fee, which in mezzanine is pretty standard. So we generate $6.5 million in management fees in a given year. If we have approximately a 10% cash-on-cash yield in our portfolio, meaning that we have a little bit less than our cash coupon because we might invest a little bit of equity in a deal, or we may get paid in kind as opposed to in cash for a small piece of the transaction, that would mean that we would have to invest about $66 million of our fund to generate $6.6 million in the management fees that we charge each year. So when you think about our fund going forward and adding it to your portfolio, once we get beyond $66 million invested, we are generating positive net cash on a quarterly basis. And then we take that net cash and we distribute that to the LPs. So net after management fees, once we're beyond 15% invested, we are a quarterly distributor of cash. Today we have $130 million invested. So on a quarterly basis, as some of our LPs can vouch for, on a net basis, we're distributing to our LPs about a year or so after, a year and a half after we've raised or had a final close on our funds. And I think that's what's getting folks interested, particularly today with a lack of distributions. Certainly not the case from Carlyle and Silver Lake's side, but many middle market and other large funds have had trouble getting exits and generating distributions for their limited partners. As a Mez LP, what should you be looking for? And I have a viewpoint on that. Obviously, others will have different opinions. But I think first and foremost, Ed touched on it, quality due diligence, regardless of asset class. Private equity, venture, tech buyouts, mezzanine, even though you're taking less risk, you can lose your money. So quality due diligence is at the top of the list. People who are good at credit, making sure that they've done lending in their past, and not only bank lending, but mezzanine lending, lending that you have to look to the value of a company versus just the hard value of the assets. Ability to generate your own deal flow, which allows you to be choosy. The more deal flow you generate, the more relationships you have that come in your firm, and generally those relationships for a middle market buyout firm would be middle market private equity firms. For a large mezzanine shop might be a relationship with Carlyle or Silver Lake and trying to be involved in their transactions. The more choosy you can be, the better diligence you can do, the better credit, the better you are at credit, the better your returns will be in that spectrum of gross and net returns. And then I think just having an understanding of private equity, either having invested in private equity, having been a banker who covered private equity shops over time, understanding the motivations of how their general partnerships work, who the better partners are, who the more active partners are, is actually a pretty important part of being a good mezzanine lender. Just taking a different tack, although tying mezzanine to private equity, aside from the investor side, which we covered a bit, is mezzanine is somewhat of a different angle of playing the private equity business. And what do I mean by that? You've definitely heard the comments, there's too much money chasing too many deals. Ed noted buyout shops, buying businesses from other buyout shops. There are no bargains out there. We're chasing too many auctions. It's an efficient market. We're paying too much. In the big cap market, you're seeing a lot of partnering on transactions, and that's the first sign of not enough deal flow for the larger cap companies. On the middle market side, there are numerous middle market private equity funds. And to tie this to some numbers, let me tell you what I mean by that. Multiples of cash flow or multiples of EBITDA today to get a private transaction done or an LBO have increased from early 2000 at 6 times cash flow today to 7 or 8 times cash flow as folks are thinking there's going to be a turn in the economy. In the businesses where a private equity shop buys something for 6 times cash flow, we might lend 3.5 times cash flow to that business. Or the same thing with that house where they're taking $90 of risk on a $100 house. We're taking 3.5 times cash flow of risk on a 6 times multiple that someone might pay for the cash flow of a business. And that's a relatively straight line on a 7 times cash flow business where we might think it has more value, or we might think the cash flows are more diversified. We're taking a little less risk. We might lend 4 or 4.25 times that cash flow. And if someone's willing to pay 8 times, and there's a reason for that, and there are deals getting done at those multiples today, we might lend 4.5 times cash flow for that business. So what does that mean overall as an investor? Well, when the deal does well or doesn't do well, what you tend to find is we are lending 3.5 to 4.5 times cash flow in a business trying to generate a 16 to 19% return. And the private equity investor is investing at 6 to 8 times cash flow, trying to generate a 20 to 25% gross return. And 3 things often happen. 1, you both made a bad decision, both the private equity investor and the mezz investor. The equity loses their money, and highly likely the mezz loses their money or gets somewhat of a recovery. The deal does reasonably well, where the mezz gets maybe a 11 to 15% return, and the equity gets their money back. And the deal does very well, where the mezzanine might get a 20+% return, but this is where private equity really helps you. They may get 2, 3, or 4 times their money back. And that's the case where a private equity fund can lose their money in transactions completely, but make it all back in one deal. And in the mezzanine business, you really have to be careful about losing your money, because we may generate a 20 or 25% IRR and get 2 times our money, and we have to balance that with the very few amount of times that we could make a mistake and make a bad investment. And that really is one of the reasons that I hearken back to good due diligence and investing with mezz investors that you believe are very good at credit, because that's quite important in the business. And lastly, just to finish up, and it's certainly not unimportantly, what are the risks in mezzanine investing for those who are less familiar with the asset class? At a fund level, you really can't have many losses, hearkening back to the example that I gave you. I'll use our fund as an example as well. In a $440 million fund, you might do 20 deals of $22 million mezz investments on average. You probably need to be right 16 to 17 times. And on the 3 or 4 that you're wrong, you would hope that you don't lose all of your money on 2 or 3 of those transactions. That's a pretty high batting average. Most private equity firms, if they were able to do that, taking the risk they do, would have phenomenal returns. But on the flip side, we are, as I noted, lending 3.5 or 4.5 times cash flow to a business that the private equity investor may be paying 6 or 8 times. So our chance to have a higher batting average is probably normally good. You still have to do your homework and do your due diligence to avoid making the big mistakes. Credit skills are key, as I noted, and while you do have downside protection, you can lose your money in a mezzanine fund, and credit is really critical. The second one is understanding the type of mezzanine that you're investing in. As Ed noted, there are lots of different strategies. Silver Lake has a specific strategy of tech buyouts, which has worked quite well for them. In mezzanine, it's not really industry focused as much as it is type of mezzanine. And what I mean by that is in the Audax mezzanine funds, we have a debt-oriented cash pay strategy. So we're a little bit more vanilla. We're looking for a cash pay coupon in virtually every deal that we do. There is mezzanine that is more preferred stock oriented, where you get a full pay-in-kind coupon, and you're taking a little bit more equity risk in the transaction, and you're not necessarily looking for a cash return, but you probably can earn a higher all-in return if you're right more of the time. However, if you're wrong, as a preferred stock, you can lose your investment much more easily in a transaction because you're not generally either secured, and the mezzanine or any other debt investors do come before you if something does go wrong. The other type of mezzanine investing is late-stage venture mezz. Both of those strategies are potentially successful. They are a little bit different, and they are a little bit riskier than what I would call vanilla mezzanine. And lastly, I would say strategy creep, which is something that Ed alluded to as well, which is people do bounce around as they make investments and do or don't have success, sticking to the strategy that the GP laid out to you in a fundraising, and making sure they stick with that in either semi-annual or annual meetings with that general partner is critical. Because straying off of the reservation in mezzanine can be quite dangerous. The folks who stick to their knitting actually can make a fair deal of money in the business. Just in closing, I think as you look back over the last, I've been around the business for about 18 years, both in high yield and mezzanine. Private equity firms have a need for mezzanine. They have it more so in cycles when the banks are tight on their lending standards. It's been around for dozens of years. Insurance companies have been investing in mezzanine for more than a couple of dozen years. And it has really become more of a mainstream asset class to pension funds, university endowments, and other, because of the reasons that it generates a little bit more of a baseline type of earnings for a portfolio, and it also generates distributions a little bit earlier. So as an investor, I would consider mezzanine as a part of a balanced portfolio, but I would certainly do my homework on the types of funds you might be investing in, and particularly the people within that fund and what their knowledge base is. So those are just some general thoughts.
Thank you, Kevin. Just a quick related question, actually just a sort of double-barreled question. It seems to me over the years, sort of observing the industry, that mezzanine pricing really doesn't tend to change. You can have the debt markets or the credit markets going up and down in terms of rates, but mezzanine seems to hold fairly constant. Can you give me a sense for why that is, number one? And number two, aren't there times when bank lending is so available that, in fact, there isn't an opportunity for you as a mezz player, and how do you deal with that?
Let's cover the pricing question, because I think that's been true all for probably the most recent 6 months. And I'll explain that a little bit. Because mezzanine is effectively a private equity asset class, you are investing for an all-in return. And because you can risk your capital and lose your money, to move with the pure fixed income markets, because the 10-year might be at 4%, and take your returns to a spread to the 10-year treasury, means that you will be getting not enough return for the private level of risk that you're taking. So generally speaking, in mezzanine, I think you've seen a range of as low as 16% for the required IRR, Peter, or as high as 25%. In 2000, mezzanine was getting priced at north of 20%, and private equity was getting priced, or I should say 2001,
right, at
north of 25% if you could get transactions done. And that quickly came down as the economy has rebounded and the bubble burst has started to move back a little bit. Recently, with rates as low as they are, that has had some impact, but the other impact on the business has been some public vehicles who generate their dollars from the public markets, which is a cheaper source of capital, tending to price mezzanine down, frankly, in our opinion, a little bit lower than the risk they're actually taking. Because the public investor doesn't get the forum that you guys often get, which is to hear about what the real risks are in the business and spend more time with us directly. So I think that range of 15 or 16 to 19 is at the lower end of the range of the spectrum of mezzanine investing today. So I think that is the case, but that's probably the reason that you don't see mezzanine moving directly with the fixed income markets. On the bank side, bank availability in 2002 and 2001, when we were raising and closing the fund, it would have been a stretch for a middle market bank to lend more than 2.5 times cash flow to any of the businesses that we invested mezzanine in buyouts. Today, those very same banks are lending 3 and 3.25 times cash flow. In mezzanine, we would be lending 3.5 times to that same business. Today, that very same business might be getting 4 or 4.25 times cash flow. And that's really just the perception of what's going on in the markets. To Peter's question, what is really happening at certain banks is those banks that want to put more assets on their books are reaching for that next turn of leverage, if you will, and booking that at a higher rate of return than the bank debt. So in some cases, in some transactions, you'll get the banks, if you will, stealing a little bit of your investment rate. But overall, I would say it's probably in 10 to 15% of the transactions we look at. And we also move our leverage ratios a little bit as the banks move further, because with their lower interest rate lending, it generates greater cash flow overall in the business as opposed to a mezzanine loan. So it helps make the deal a little bit safer, and we might be willing to lend a little bit when the banks stretch as well.
I'd love to push back on that, but we've got to keep moving. So to technology buyouts, I know when Silver Lake raised its first fund, it was an oxymoron to think that you might do buyout investing in the technology field. Buyout being kind of a singles and doubles kind of a business. You want a very consistent record, and the tech business being incredibly volatile and cyclical. How did the two meet? Well, it was met. Certainly, the team at Silver Lake met that with a remarkable aplomb. And I'd love to get a little background on how you've done that, Mike.
Okay, thanks, Peter. Why don't I spend a couple of minutes just talking about private equity generally, our outlook for the business, some of the issues facing the industry. And then maybe I can wrap up by getting into Silver Lake's strategy a little bit and how we're addressing some of the issues that we see. Full and fair disclosure, as many of you know, we are in the process of raising our second fund, so I will do my best to spare you all the commercial, which many of you have heard. In terms of outlook, I think we all have to acknowledge that the private equity industry operates in a state of perpetual schizophrenia. And the reason I say that is, we spend a large portion of our day looking for new, interesting investments to make. We also have a big portfolio to manage. So we're never quite sure whether we want the market to go up or down. I guess in that respect, you might say that we're a little bit hedged. I guess that's the favorable way to look at it. But the conventional wisdom is obviously that when the market's really hot and valuations are up and public money is abundant, we're supposed to be looking for value in the portfolio and to get some realizations and return capital to you all. And when the market is downtrodden and valuations appear cheap, public money is harder to come by. That's a fertile time for making new investments. If I had to hazard a guess, and I'm looking in the rearview mirror when I make this statement, I think we've just come through an inflection point in sort of the balance between those two competing things, one of which drives the actionability of our investment process. The other one, sort of drives the attractiveness in some respects of the opportunities that we see. You guys look at this data all the time. I'm not sure there is enough data, to Ed's point, to really plot a long-term trend, but it's pretty obvious that private equity investments tend to outperform when they're made during the early stages of an economic recovery. I think what you guys will see is that, it's my guess, and the truth won't be known until everyone is well into their next fund. But if I had to guess, the investments that were made in 2002 and the early parts of 2003 are going to look pretty good relative to historical norms. But I think that my overarching point of view is that none of this really matters. I don't think it makes sense in the context of making 3 to 5 year liquid investments to ever try to be a market timer. I don't think it can be done. I think the inflection points in our economy are often only really clear until long after any of us has the ability to act on them, particularly when you think of our investment process taking 3 to 6 months oftentimes to go from identifying a new opportunity to actually closing it. I think it doesn't make sense to be a market timer. I think, to Ed's point, you have to look at returns on a relative basis. Of course, we're dealing with a cyclical industry. It probably is lower beta than other asset classes, but certainly the private equity business and private equity returns are going to be influenced by what's going on in all the other capital markets. I think the good news is, at least it's our position, that there are good deals to do in every market environment. I think the recurring theme of the little talk I'm going to give is going to be that investment selection is the secret sauce. It has very much replaced financial engineering in that regard. The top performing funds, as you guys are very familiar with the data, in any vintage have obviously produced attractive returns, but there is wide disparity, massive standard deviation between the top funds and the ones that aren't performing as well, even the average in some years. And again, I think it all comes back to investment selection, which I want to spend some time on. I think, depending on how much caffeine I've had, if you asked me to say what environment are we in right now, and you look across the entire private equity value chain, identifying and sourcing new investment opportunities, picking the right ones to do, getting the deals done, adding value to the portfolio companies, and then achieving realizations, I think we're in a very average private equity marketplace. The good news, bad news equation I think is something like this. And in terms of good news, I think confidence is coming back. I believe that confidence is the biggest driver of deal making. It dramatically overshadows valuation or industrial logic or any other kind of logic. When managers feel confident, they're willing to do things. They're willing to work with private equity firms. We're in a much better environment in terms of people's headset about the future, and I think that helps make our ideas actionable. A lot of people ask us, you guys are tech investors, you say you're smart guys, why didn't you invest your whole fund in 2001 when, the tech market was at rock bottom? And believe me, it was not for lack of trying. We went out and pitched aggressively a lot of interesting deals we thought were interesting. A lot of times the feedback from the management teams and the boards was, yeah, it is interesting. I do think my company's undervalued. I do think you guys have a creative idea. I do think things will get better. But if you think I'm going to go to my board while Rome is burning and pitch an MBO, you're crazy. And the truth is, when the economy's down and businesses aren't performing, managers are heads down, trying to run their businesses better, and that 9 times out of 10 is the right thing for them to do. I think what we're seeing now is that there is a little bit of hope out there, in some cases a lot, and it's easier to do deals. The second thing, in terms of what opportunities are we likely to see, there appears to be a pervasive focus, and I think this is another cyclical trend, within large corporations on what is core. And again, I don't think this is anything new. I think you see it in every business cycle. But we are seeing many large conglomerates looking to shed non-core assets, looking to find a partner to help them work out a kink in their business. I think that bodes well in terms of new private equity opportunities. We're seeing a lot of these, and I think I wouldn't be surprised if we didn't make some investments along that line. The third thing I'm not going to spend a lot of time talking about because it's been well covered, but the financing markets are back in full swing. It's less relevant to Silver Lake, but and I wouldn't say they're white hot relative to historical norms, but there is plenty of money available to do deals. Some of it coming from new pockets of capital, like what Kevin does in his business. So that's obviously helpful. The bad news, again, a lot of these points, I think what I'm going to say is probably very consistent with what Ed and Kevin said. But, valuations are up, particularly in tech. We've seen the NASDAQ go up 40% this year, round numbers. Again, this gets back to that healthy tension of confidence and actionability versus the attractiveness of opportunities. I don't think the market's efficient. I think it's particularly inefficient in tech. There will be good deals to do despite the rising tide. Again, it comes back to knowing which ones to do and where to be aggressive and where to step away. I think you will also see a lot of auction processes, particularly in these situations that I described where companies are divesting businesses and they have one priority, which is to maximize the cash that they get for whatever it is they're selling. I don't think auctions are bad. I just think you have to know how to pick your spots, and again, it comes back to investment selection. The other thing, I try to think of some things that didn't come up before. The scandals that have taken place over the past few years have had an impact on our business. If you just look at what Tyco and Enron and Adelphia and WorldCom have done to corporate America, it's pretty striking. I think creativity, at least in terms of financial engineering and deal structuring, is trading at an all-time low. It's tough because our business in the past has really created some primary demand for our capital because we're able to structure things creatively and solve business problems that are too complex to solve through public financings. No management team or board wants to be a pioneer or the test case for a new investment structure. So I think on the margin that hurts a little bit. There is a silver lining in that there are a lot of public company CEOs that no longer want to run public companies, and I think that might generate some deal flow, although I couldn't agree more with that. This used to be called the buyout industry. It's very hard to do public to private buyouts. It's very challenging structurally. The other thing about financial engineering is it has now really become the table stakes in our industry. It's not to say it isn't important. It's hugely important to structure deals well. It still differentiates private equity and mezzanine from other asset classes. But in terms of differentiating the funds from one another, it's been entirely commoditized. Every fund in private equity has core competency in financial engineering, and I think that what that's causing folks to do, which I'm going to come back to later on, is you have to start to develop competitive advantages in other places of the value chain, investment selection, value added, those types of things. Simply not good enough to know how to finance a deal or how to set it up. Everybody's got those skills. And the last point, which everybody's made, but is true, there is a lot of money in private equity chasing a few deals. I think the last number I heard, you guys would know because it's all your money, but there's some $200 million committed to the private equity asset class. Not sure that there's an overhang. There's certainly plenty of opportunities for everyone to do good deals, but on the margin, more money chasing deals is not a helpful thing in terms of IRRs. In terms of Silver Lake strategy, we have a pretty simple strategy. We're trying to create as many unfair advantages as we can for ourselves. There were just way too many smart people in our business. We don't think it makes sense to try to compete by being smarter than everybody else. We think that there really needs to be some business model innovation, and I think we try to do that technology style, which means we don't really innovate anything. We just steal the best practices of every other firm out there, or at least try to. One of the things that we do, obviously, is we have a vertical focus. All we do is tech. We want to be idiot savants. The notion is that technology is dynamic enough and in some cases esoteric enough that these businesses and industries cannot be understood over the course of a 4 to 5 week due diligence process. Again, this is not a novel idea. Ed's firm has done this in aerospace and defense and probably other verticals for a long time. But I do think it's important. Really, by focusing, it gives us the opportunity to react more quickly, to know in advance where we want to be, to know which management teams to form relationships with and whatnot. There's big inefficiency in it. Second thing is we've tried to be structurally agnostic. If you look at, even in our short history, we haven't done the same deal twice. We've done buyouts, recaps, sponsored spins, minority investments, even pipes, even a distressed investment. So, why do we do that? We're not doing it, just for the sake of variety. Again, it gets back to that tension between actionability and attractiveness. Fundamentally, we believe that we are long-term, late-stage, large-scale tech investors. That's not to say that we don't understand the trade-offs between and among these different structures. Obviously, if we had our druthers, we'd prefer to have unilateral control, 6 weeks to a month to do our work, we'd have all the downside protection in the world, we'd have perfect liquidity, and we'd invest at 4 times cash flow. But that package of value is just not to be found. So what we're trying to do is to use structure as a tool to make our ideas actionable. We find companies in which we want to invest, and then we need to come up with structures that allow us to put our capital to work in a way that solves a business problem for the target company. The other thing that we're obviously trying to do is to alter the risk-reward dynamics of the situation, for the betterment of our investors. So structure is a tool, but I think if you are going to go to a model where you're focused on an industry, you really have to have a lot of flexibility if you're going to put your ideas to work. I know pipe has become a 4-letter word within the investment community. Some of our best deals are pipes. Sometimes that's the only way that we can put money to work in the companies in which we want to invest. Sometimes we just prefer to buy influence at a discount rather than control at a premium. I think we acknowledge the issues with not being a control investor, but there are upsides in terms of liquidity and sometimes current yield. But a lot of times it just gets back to investment selection. I think that's the key. Find the companies in which you want to invest. In some cases, convince them to take your money. And if you have to do that through a pipe, that's okay. The last thing I want to talk about, and Ed touched on this, we're huge believers in it. Again, it's not a new idea, but the ability to add value to your portfolio companies on the margin will help you put more money to work because you can sell that to management teams. I think it will also make our returns better. And, there are a lot of firms that have been doing this. I would, I guess I'd submit to you that any private equity fund would do anything that they could to help their portfolio companies, but to do this well really requires some business model innovation. Obviously, going back to the point I made about financial engineering, private equity funds are good, helping their portfolio companies with anything related to deal making and spreadsheets. We're trying to go a little bit beyond that. We want to help in areas like recruiting, communications, corporate development. And when I say corporate development, I don't mean M&A. I mean really new customer acquisition, new supplier acquisition, technology alliances, marketing partnerships, outsourcing strategies. To do this means that you have to build a firm in terms of the partners that you bring together that are capable of assisting in those areas. Again, not a new thing, but we believe it's really important to have partners with operating experience. They bring a wealth of domain expertise to the table. They have huge Rolodexes. They know everybody in the industries in which they come from. And to be perfectly honest, they play better with management teams than a dweeby ex-investment banker like myself. I mean, the management teams want to sit across the table from somebody who's walked a mile in their shoes, and it's a huge advantage to us to have access to those people within our firm. The last thing that I'll mention is using our investor base as a strategic weapon. We have aggregated within our fund, over 150 technology executives who have personal money committed to Silver Lake, and these folks are really helpful. I mean, they're not all obviously super involved, but they are people that we can turn to make a call, to arrange a meeting, to assist us with our due diligence. Certainly when they have a new idea in terms of an investment or something that could benefit our portfolio companies, they let us know. Again, this is sort of enhancing the value proposition around the margin. I think that's. I think we're running short on time, so maybe we can.
We are. Perhaps you can get a sense for why Silver Lake is oversubscribed in their current fundraising. One last quick question. We're going to throw it open to questions. So, are you happy with a 1.5x, 2.5x? What's your bogey?
What's our bogey?
Yeah.
Our philosophy is to try to find two ways to win in each investment. So we're looking for technology companies that have a stable component to their business that produces a certain amount of cash flow that hopefully we can underwrite to 2 times our invested capital. And then we're looking for some type of transformational opportunity in the business or a growth avenue that if it works, and we'll do everything we can to make it work, then we could generate 3, 4, 5 times our money. We certainly go into things though hoping to make at least 2 to 3 times.
And protecting yourself to accomplish that. Why don't we already.